It is good news indeed that the bankers are making money in the market, but I assume it must make a lot of policymakers very unhappy, particularly given the pressure that has been exerted on the industry to lower lending rates to the rest of the economy.
Yes, definitely. Anytime that the economy starts showing upbeat signs, then of course banks are the first to be the beneficiaries. So banks have sort of become more they've released their funds in order to lend to the private sector compared to a situation in 2008, 2009 where they are mostly in government securities.
Let's talk the raw numbers here, Steve, if we can. Now, total banking sector profits up 45.7% in the 11 months to November. Now, that's a big increase, particularly if you look at where inflation is. Where is the driver for this? Where is the money coming from?
The money is mainly coming from interest income and mainly from loans and advances. Like I mentioned earlier, that you're seeing the profile of the assets of the banks changing from investment in mainly government securities, which have lower yields, to loans and advancements, which have higher yields. So it's the main driver of the profits is the interest component.
So that will give fuel and ammunition to critics who say that the banks are actually profiting from higher rates while at the same time refusing to lower lending costs to the rest of the economy. Now, in terms of the volume of loans that were given to businesses, how big an increase are we seeing?
Well, to the manufacturing arm, we are seeing quite a substantial increment. To the household, not much, because there's still a lot of caution in terms of banks also want to maintain quality loan books. They want to sort of reduce their NPLs.
But at the same time, we're seeing overall spreads for the banks up 46 basis points. Now, what is that a function of? Is that the banks becoming more profitable, or is that a function of the banks maintaining lending rates high while at the same time profiting from the higher lending rate from the central bank? Sorry, lower lending rate from the central bank.
Well, it's a situation where banks are sourcing cheap funds in terms of lower deposit rates, so they're not necessarily paying competitive rates for deposits, while at the same time using the same funds to be able to lend at higher rates, hence the spreads, hence the widening of the spreads, but also factoring in any risks that they perceive.
I imagine the Central Bank of Kenya, as well as the politicians, will definitely be looking at that number and thinking, these guys, despite all our entreaties, they are not actually lending to the rest of the economy fairly, if you like. But let's just look at the sustainability of the growth that we are seeing. What are you forecasting in terms of overall profitability for the banks for 2010 and also moving into 2011?
Well, moving into 2011, we expect the same momentum. But we're expecting a slowdown, say, going into the fourth quarter 2011 and going into 2012, probably because of sentiments in terms of some maybe political aspects going into an election year. But that notwithstanding, you find that as long as banks are starting to make money and being profitable, then also risks tend to start coming in terms of loan defaults, in terms of over-leveraging, in terms of the consumer debt increasing.
What can the CBK do here? I mean, we have heard their message around trying to reduce the cost of borrowing for the rest of the economy, and we saw that surprise cut in their benchmark rate the last time that they set. But what other weapons do they have to try to get the banks to lend to the rest of the economy at what one would say would be reasonable rates?
Well, CBK has tried in terms of ensuring a low interest rate regime through the lowering of the CBR rate and the cash reserve ratio. But that's still not enough, because you find that the CBR ratio is mainly used for banks to borrow from CBK, but there's no onward effect in terms of lending to the private sector. So I think CBK needs also to actively engage the banks in terms of probably getting the credit reference bureaus to be able to diverge more information on borrowers so that banks can comprehensively assess the risks involved in lending to their customers. So that probably in terms of getting the right information, then rates can actually come lower.
Yeah, but I suppose any investor listening to this story would be thinking perhaps the place to be in the Kenyan market has got to be the banking sector. Are we seeing a stampede for banking stocks, and who are the main beneficiaries?
Well, it started in the fourth quarter of last year after the release of the third quarter results, where most banking stocks overheated a bit, the likes of Cooperative Bank, Equity Bank, KCB. But come this quarter, we've seen some correction taking place, some profit taking, and we should see that some marginal increments just until the results come out. And it's a situation where there's also information leaking probably before the final results come out. So some inefficiency also taking place.